Welcome back to the channel. I'm Dave Russell, and I have a special guest on the channel today. He's not going to be new to you, but he's definitely new to the channel, and that's Jared Dillian, ex-Lehman Brothers trader, and he is also of jareddillionmoney.com. He's author of the Daily Dirtnap newsletter and also of the book No Worries: How to Live a Stress-Free Financial Life. Jared Dillian, welcome to the channel.
Hey, thanks for having me.
Great to have you on. Now, you're the author of a book called No Worries: How to Live a Stress-Free Financial Life. Now, at this moment in time, there is a lot of stress about now, whether that is an uncertain Federal Reserve at this moment in time. We've got inflation rearing its head again. We've got a divergence in monetary policy across the globe. We've got geopolitical tension, whether that is wars or whether that's an East versus West divide. We've got de-dollarization, and also we're looming into a uncertain electoral cycle now. There's a lot to be stressed about. How do we live a stress-free financial life in this scenario?
Yeah, well, there's two sources of financial stress, and one of them is debt, and the other one is risk, right? And risk in the financial markets. So let's talk about the risk part for a second. The vast majority of people don't care about de-dollarization. They don't care about, they do care about inflation, but not to the extent that we care about it. They don't care about all the things that you mentioned. They're just trying to invest and save for retirement, right? And the conventional wisdom around that has been that you put all your money in the S&P 500 index fund and you dollar cost average and you hold it forever. And when you retire, you have $2 million and you retire. So the problem with that thinking is that when you invest in an index, you get the returns of the index, which are very good, but you also get the volatility of the index, right? So the S&P 500 is very volatile. It moves around 15 to 20% a year, up and down. Sometimes you have bear markets. Sometimes you have big bear markets. There's been 4 bear markets in history of 50% or more. Over the course of an investing lifetime, you'll probably have one of those big bear markets. So it's really unrealistic to ask people to stay invested throughout all of that volatility. And most people can't do it. Most people, once they experience a bear market, they liquidate their holdings and they stop compounding. So the solution to this is to construct a portfolio that reduces your volatility and gives you something close to the same in returns as the stock market, right? So what I came up with was something called the Awesome Portfolio. And the Awesome Portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And the amazing thing about this portfolio is that it returns about 1% less than the S&P 500, but you get half the volatility. So you trade off a little bit in the way of returns, but it cuts your volatility in half. And the worst drawdown in the history of the Awesome Portfolio is 12%. That's the worst year that you could possibly have historically. Whereas in the financial crisis, the S&P was down 38% in 1 year, and the Awesome Portfolio was down 9%, right? So if that's your worst case scenario in the worst economic crisis since the Great Depression and you're down 9%, I think that's pretty good. And when a lot of people look at this portfolio, they say, like, this is nuts. Like, why would you have me in a 20% gold position, right? Like, I can understand maybe 2% gold or 5% gold, but 20% gold, like, this seems unreasonable. And the role that gold plays is it is the ultimate diversifier, right? So I kind of have an analogy for this. It's about Dennis Rodman. Okay, gold is Dennis Rodman, right? So Dennis Rodman is in the Hall of Fame, but he only scored 6 points a game. Okay, So if you had a team full of Dennis Rodmans, it would be a terrible team because it wouldn't score.
Mm-hmm.
But what Dennis Rodman could do is he could rebound and he could pass to other players. So when you take a Dennis Rodman and you add him to a team of four other players that can score, it becomes a championship team. And that's really what gold does. If you had a portfolio that was 100% gold, it would probably not be too exciting. But as soon as you add gold to a portfolio of other stuff, it brings the risk down a lot. It brings down the volatility. And the reason that is because gold isn't really correlated to anything else. It's correlated to things over short periods of time, but those correlations are unstable and they drift over time. So it is the ultimate diversifier. So I don't think having a portfolio with 20% gold is unreasonable at all. I do think a portfolio with 80% stocks is incredibly unreasonable.
Okay, and in terms of your awesome portfolio, then, do you think that that is the construction of the type of portfolio that is suitable for somebody looking into what we're looking into? I mean, are we going to be experiencing increased volatility? Do you think that we're on the verge of one of these large drawdowns in the S&P?
I do actually. You know, I mean, there's a whole bunch of stuff. Just a couple of my thoughts are kind of all over the place, but
That's
just a
all right.
couple of tidbits. You know, we have celebrities and football players and athletes starting private equity firms. Apple announced that it's going to have Chat GPT on its phones, and the biggest stock in the world goes up 15% in 2 days. Um, Nvidia has just gone parabolic. This is very late cycle type of stuff.
Mm,
It really, I'm now to the point where I'm old enough. I started in the business in 1999. I started in the .com bubble, and really the first few years of my career, we're seeing this unwind.
mm.
It's very similar. It's very similar.
There's a baptism of fire starting straight into the dot-com boom.
Yeah.
But you also, and there are some parallels with that then, because and it's a very similar time to when I started in the markets, 1997, and just watching that unfold and the euphoria that was about when it came to dot-com stocks. And just before we saw the crash, because everybody talks about the dot-com crash. Um, but just before the crash happened was when we saw the greatest moves, the parabolic spikes. And that's echoed now today with what you're talking about with Nvidia and Apple as well. So very much is that kind of that late stage end of days scenario. Would you agree with that?
Yeah, I mean, if you pay attention at all to Elliott wave, right?
Mm,
So this is like wave five type of stuff where you get these blow off tops. Um, so yeah, I mean, look, like I'm short some things. I'm not short Nvidia. I have some puts on the S&P 500 mostly as a hedge, but I'm not aggressively short the market. It doesn't really make sense to do that until you have a technical break, which we haven't had yet. But I am heavily invested in gold and a lot of other stuff that will gain in periods of disorder. So.
good. We'll get on to talking about gold a little bit more in a little bit more detail. But just in terms of what's going on in the broader economy and geopolitically as well, what gives you the most pause for thought? What do you think is going to be a greater catalyst for the next bear market, given all of the things we talked about there, whether it's the idea of de-dollarization, geopolitical tension, um, the growing national debt, where the Federal Reserve is basically being painted into a corner where they they can't cut rates, but they'll fuel inflation. And if they raise rates any further, they're increasing the interest burden on the taxpayer and the budget. So
Um,
what's the
I
straw that
mean,
breaks the camel's back?
honestly, basically what happened was during the pandemic, we had enormous amounts of fiscal and monetary stimulus, which created huge distortions in the economy. And it's really taken about 4 years for those distortions to wear off.
Mm,
So what you're starting to see is, back couple of years ago, we had 11 million job openings. Now we have 6 million. That's come down a lot, off a lot. The labor market is weaker. We get a claims number today. We've had a few claims numbers that are a little bit weaker. The inflation data is actually coming down, at least in the short term. We had a horrific Chicago PMI number. So there's been, with the exception of payrolls last week, there's been just a run of really soft data. And like I said, I think we've kind of, that pig is passed through the python, right, so to speak, of those distortions from the pandemic, I think are wearing off. And I think we're returning something to like a normal labor market. So I think we are going to experience a recession. I don't know how severe it's going to be, but what you're going to see is unemployment trickle up to 4.5, 5.5%, something approaching normal. And what will be interesting is after the election to see what the response to that is. After, in 2025, let's say we start to experience a recession. Does the government respond with more stimulus, fiscal and monetary? And does that increase the debt? You mentioned the debt. There's a lot to talk about there, but I'll just leave it at that.
Okay. 20% of the awesome portfolio invested in gold, as you said. And how did you arrive at the 20% figure? Was this something that you back tested various different allocations to gold and found that that's the best allocation, or how'd you arrive at that?
This was back around 2017, and I was basically just tinkering. I was tinkering with different portfolios. The awesome portfolio is a variation on the permanent portfolio from Harry Brown. The permanent portfolio is 25% stocks, 25% bonds, 25% cash, and 25% gold. And what I found was that when you add real estate to the allocation, some interesting things happen. It makes it more sensitive to inflation, so it tends to benefit from increases in inflation. And again, since real estate is less correlated, it tends to smooth out the volatility. So I actually didn't find an optimal asset allocation. I didn't try 17% gold or 23% gold or anything like that. But 2020, 2020 produced a pretty good result. So,
And why gold? What is it that you specifically like about gold?
well, like I said, it's the ultimate diversifier. Um, you know, I've invested in gold personally since 2005. I actually didn't own any until GLD came around, right? And I was actually running the ETF desk at Lehman Brothers, and some guys from the World Gold Council in State Street came to my desk, and they said, "We're launching this physical gold ETF." And I looked through all the paperwork, the authorized participant agreement and stuff like that. And I said, "This is an incredible financial innovation." So that's when I started investing in it. And then along the way, I've accumulated some physical as well. So yeah.
And the physical, obviously, is something that very much the people who watch this channel and our client base are interested in. You have an allocation, obviously, into the GLD ETF. What's your motivation for holding the physical?
Just really, I think there's a lot of ways to get exposure to gold, right? You can do it through the ETF, you can do it through futures, you can do it through physical, you can do it through gold mining stocks. Each of those has their own positives and negatives. The nice thing about GLD is that it's incredibly liquid and the transactions costs are low, and it gives you exposure, that it gives you instant exposure that you can't get through the physical market. But I think it's good to have some physical, just break glass in case of emergency kind of stuff. And also, if you think about the remote possibility of confiscation, um, any gold ETF in your brokerage account would immediately be confiscated. Having physical in a safer secret place in your house, if you want to get really paranoid about it, it's good to have a little bit. So
I like it. Now, no worries, how to live a stress-free financial life. You say the two things there are debt and risk, are the two things that create the most amount of stress. What are your top tips for managing those?
Um, so debt, there's really four big forms of debt that I talk about in the book. It's credit card debt, student loans, car loans, and mortgages.
Hmm.
Um, and a lot of people view mortgages as safe debt. It's a good kind of debt, and it is. That is true. But it doesn't mean it's not without risk, you know. And the interesting thing is that it's been 16 years since the housing crisis, and people seem to have amnesia about what could go wrong with real estate. What could go? I mean, real estate prices don't necessarily have to go up all the
Hmm.
time. So, for people who are getting VA loans and FHA loans and other government subsidized loans where they put 0% down or 3.5% down, you're starting from a position of negative equity. And if you get 100% financing on a house, it's going to take you 10 years to get to 20% equity. Okay. So, all debt is bad, right? Some is worse than others. Student loan debt is probably the worst because you can't discharge it in bankruptcy. But yeah, in the book I talk about all the different forms of debt.
Okay. So managing risk then, what's the best thing that people can do to manage risk going forward now in the environment that we're looking into?
Well, people have different risk tolerances, and also people have different historical perspectives. You started in the business in 97, I started in 99. Some people started before us and they remember the recession of 1991 as
Mm.
well. Some people remember the crash of 1987. I was 13 years old when that happened, but I've read about it plenty, so I know that it is possible for the stock market to go 25% down in one day.
Yeah.
So for somebody who has a shorter career investing and they haven't experienced those types of drawdowns, they are really blind to the risk, the types of things that could happen. So, I think the old guys like us can sort of educate people on, what has happened historically. So,
And if our viewers want to find out more about what it is that you do, where can they find you?
so my personal finance website, where all the personal finance stuff is jareddillianmoney.com. I do have a newsletter for more professional investors. It's called the Daily Dirtnap. You can go to dailydirtnap.com. And if you want to buy the book, it's on Amazon, it's in stores. It's called No Worries: How to Live a Stress-Free Financial Life.
Well, what I'm going to do is I'm going to stick a link to all of those in the show notes below here in the description. So if anybody wants to follow up with Jared, just click on those. But for now, Jared Dillian, thanks for joining us on the channel.
Thank you.